Canadian Depository Receipts, CDRs. They're essentially modeled after the American Depository Receipt, or ADR, which is a bank-issued certificate representing a fractional number of shares in a foreign company for trade on a Canadian stock exchange. So essentially, Canadian depository receipts are listed in Canadian dollars on Canadian exchanges, so Canadians now have better access to large US tech stocks for a fraction of the price and no longer need to worry about those pesky foreign currency fluctuations, which can help or hinder their returns, of course. Let's say someone only has $1,000 Canadian to invest in Amazon. Well, they can't go out and purchase one share of Amazon on the NASDAQ, because I believe it's around $3,400 US right now. So instead, they could turn to purchase the CDR, which represents a fractional share of Amazon on a Canadian exchange. So with that being said, let's just jump into the pros and cons here. I'm going to just breeze over these. So the pros, like I said, lower cost to gain exposure to the company you want to invest in. Generally we wouldn't put too much focus on this. We usually just want to focus on, your overall dollars that you're investing in a company, not, the actual price per share that you're paying in the market. But like I said, with the example with Amazon, it can be beneficial if you can't purchase one share of a specific company. Now, furthermore, Canadian investors no longer need to worry about those foreign currency implications, such as conversion fees to transfer their Canadian dollars to US dollars, so that they can go purchase those US stocks. They no longer need to worry about the fluctuating FX rate, and also investors do not need to record the foreign currency exchange rate when they purchased and sold the stock to accurately calculate their taxable gain. So continuing on with the pros, dividends in Canadian depository receipts flow through to the CDR holder in Canadian dollars, which is a benefit. Investors still receive voting rights on the shares that they have. And then as well, Canadian depository receipts don't charge management fees, which is nice. So you're gaining exposure to these without getting charged, an additional fee. So jumping to the cons here. First off, this, by just exposing yourself to Canadian dollars, you are limiting your broader diversification across currencies for a portfolio. Now, currency fluctuations do not just work against an investor, of course, as they can also add to your total return if the investment currency appreciates. So avoiding currency fluctuations isn't always the best thing to do. And we would say that currency diversification is prudent in a Canadian portfolio, a well-diversified Canadian portfolio. And then furthermore, investors are still charged withholding taxes on their dividends. So just because they are receiving the dividends in Canadian dollars, investors must remain cognizant that they will continue to be taxed the same as if they held the stock on the NASDAQ or a US exchange. To sum it up, essentially, whether CDRs are right for your portfolio really come down to whether you want to avoid foreign currency fluctuations. Now, CDRs are another way of owning large US tech companies at a fraction of the price, but at the end of the day, we believe it is generally prudent for Canadian investors to have some exposure to US dollars, given the currency's positive effects on broader diversification for a portfolio.